Hi everyone, it's Alex here at Sestrin Capital Research. Welcome to our Tech Select Pro webinar. It's Wednesday, the 8th of March, currently 5 p.m. Eastern. Today we have a number of extra folks with us. We opened today's webinar to all our paying subscribers here at the Tech Select newsletter, so Pro members, but also premium members. And the idea obviously being to give folks a taste of what the Pro tier offers, and hopefully people will decide to step up. So if you do decide to move your membership up from Premium to Pro, you can do that from your Substack account settings. Any problems, just reach out and we'll help you do that. Okay, today I want to cover three things really. First of all, just to check in on where the Nasdaq is after a potential drubbing at the hands of the Fed versus Congress over the last couple of days, where there's been discussions of higher for longer rates, difficult to quell inflation, blah, blah, blah. So let's see how the Nasdaq responded to that. I want also to check in on two sets of earnings, which are in this group of stocks that you'll see us refer to as new cloud generation names. You know that our working hypothesis is that big tech is coming to the end of its growth period. Really, there's probably some juice left in the stock still, but all the main big tech companies are seeing, slowing growth, not putting in great numbers, and probably the era where they dominate tech is probably coming to an end. And coming up the curve now are new generation cloud companies who only know the cloud, didn't have to retrofit their products and their sales forces and their revenue models and their compensation structures to subscription. Companies like CrowdStrike, MongoDB, Cloudflare, Datadog, these sorts of names. We've had two of these report earnings in the last couple of days. CrowdStrike reported yesterday after the close, and MongoDB reported today after the close. So let's go through both of their fundamental numbers and also just look at their stock charts and see what the outlook looks like for those. We will run, as always, on our normal open mic basis. So any points, questions, comments, anything at all, just open your mic and shout into the system. If for any reason you don't like to do that, or you don't have the audio working, then just use the chat box in the webinar platform, or even the question set up in the webinar platform. But the easiest way for everybody's benefit is just open your mic and shout. Okay, so without further ado, let's get on and do our disclaimer. So, disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Sestrin Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestrin Capital Research. Sestrin Capital Research values both its independence and transparency and does not believe that this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's take a look and see how the Nasdaq fared. So these last couple of days, we've had Powell speaking to Congress on the topic of how the inflation battle is going. Seemed to me to be a no new news event, but Fed watchers take note, and anyone who trades short term take note. Something really important happened yesterday before the speech, which is that there was a rather hastily put out note by the Wall Street Journal. Nick Timiraos is the author to watch, the journalist to watch there. So Timiraos is in effect a transmission mechanism from the Fed to the market. So Timiraos told you, if you were watching this, that Powell was going to talk tough, but he didn't say there was going to be any tough measures in there. He just said that he would talk tough. And so if, for those of you who trade the indices, if you had been watching the indices short term, you could have seen that they'd run up a fair bit. You could see that technically they were due a correction. And once you saw that Timiraos note, you could make a fair bet that the indices were going to fall, but probably not catastrophically so. So if you were trading the Nasdaq, or for that matter, the S&P or the Dow or the Russell, all of which we cover in our real time service, by the way, then there was a great opportunity to take short positions and take short profits, which in staff personal accounts we did yesterday, closing out the shorts yesterday, and then adding to some index longs at the end of the day yesterday, and also at the end of day today. So today, for the most part, the indices have been up. Let's just take a look through those. 1 second. Okay. So let's look at the markets first. Okay. So let's just zoom out a little bit. Here we have a weekly chart of the Nasdaq going back to the December 2018 lows. And let's just refresh on where we stand on this. So the working hypothesis we have here is that we are in a so-called fifth leg, fifth wave up here, that we have a good shot at making new all-time highs in the Nasdaq over the course of the next, let's call it, year or so. And just to run through the wave pattern here, so you can understand how this works and see the validity of it based on these fib retracements and extensions. So we start the 18 lows here. This is the last time the Fed tried to normalize monetary policy. We put in a wave one up that peaks right before the COVID peak, also COVID crisis, and then we drop to the 78.6 retrace of this whole move up. So we had a big bull move during 2019, driven by looser than expected monetary policy, and then a big panic sell-off February through March 2020, dropping to the 78.6% fib retracement. We then, fueled by two things: one, options market reversal. Don't underestimate the impact of that. And then excess Fed liquidity, so free money coming into the system, being deployed, not just by retail, but also by levered hedge funds who suddenly had at their disposal a wall of very cheap money. We get a big wave three up that peaked at the 2.618 extension of that wave one. So that's a big wave three. 1.618 is a more common wave three high. So this was a big move up. Peaked to the end of 2021, and then we get, as we know, the sell-off through 22, which bottoms out. It's quite beautiful actually at the 61.8 retrace of this wave three up. So this is tested in October, again in late October, again in December, and again as early as January. So I should say as late as January this year, where that 257, 258 level on the QQQ held 1, 2, 3, 4, 4 times. And from then the Nasdaq puts in a big strong move up, peaking at the end of January, and it's sold off a little bit since then. But you can see, if we just zoom in here, that this is following quite a nice uptrend towards this wave 5 high. And if we were to zoom in and look at the smaller degree, let's do that right now. I'm going to use the Nasdaq futures for this, just a continuous contract measure, because there's more trading data. Futures trade overnight, as you know, trade Sunday evenings, as you know. So let's just look at the short-term pattern that the Nasdaq is following. This is an hourly chart for Nasdaq futures. So let's just trace it from the October low. So it's a bit of a mess here, but just bear with me as you see this. So this is the October 2022 lows in Nasdaq futures, around 10,500-ish. And you can see that it's continuously made higher lows and higher highs since then. So we get a series of 1, 2, 3, 4, 5 waves up, and then one ABC correction down. So from the October low there, the next low we get is a November low, which is just a bit above that October low. So this is starting to look bullish. We then get a 1, 2, 3, 4, 5 waves up, peaking mid-December, looking really good. But then we get another correction down to the end of December, early January. But look again, this low here in early January is above the November low, is above the October low. And so although this looks a complete mess, this chart, it's really informative. It's telling you that Nasdaq is setting up for a bull move. We then get a big strong move up in January. So 1, 2, 3, peaking early February. That's still the high of the year so far. And then an ABC sell-off into early March. And that's a wave 4 low in this 5-wave cycle that started in early January. And we look like we're in a local wave 5 up here. And one thing that we had flagged loud and clear in our real-time service, Growth Investor Pro, is that right around here, Nasdaq looked like it made a local peak. That's a straight up move, sort of a smaller degree, wave 1 up, and it looked like it could correct down, which in fact it did. And the Powell speech and the Tim Morales article were, the excuses if you like, but it was due to sell off anyway. And it's notable where it sold off too. So it bounced right at the 61.8 retrace of this move up. And it's not an accident. And aside from that spike down, it pretty much held at this 0.5 retrace. It's also not an accident where it's moved up to during the course of today. So it sat right beneath that 38.2 retrace of the prior move up here. And all in all, what you would say is, if this was the Fed swinging a wrecking ball at the markets, it doesn't look much like it. That looks pretty positive to us. So best guess, we see the Nasdaq continuing to move up to finish off this wave 5 high. Where will this end? Well, and where it ends, but a typical place for these wave 5s to terminate. And remember, this is just the smaller degree. This is a zoomed in chart. So this is looking at, where's the next local high? This isn't, a new all-time high. But if we just measure the fib extensions here, very often you'll see a wave 5 peak at somewhere between the 61.8 and the 78.6 extension of the wave 1 and 3 combined. And that says that we might see Nasdaq in the low to mid 13,000s within the space of, a month, let's say, before another sell-off down, but probably a sell-off down to another higher low. So looking back at this larger degree chart now, you could think of this, if this continues, as sort of a step function, up, down, as this wave 5 moves up. So I'd say the outcome of the Powell presentation was pretty bullish. If it was going to be disastrous for stocks, you would know by now. So an opportunity to make some short gains yesterday, long gains today, if indeed you are trading short term. Okay, let's then take a look at some earnings. Now, CrowdStrike reported yesterday after the bell, and it was a good solid quarter, but let's run through the numbers. So CrowdStrike, as you recall, it's a cybersecurity software business. It's a so-called endpoint protection business, and what that means is that it primarily deals with the devices that connect to the network. So cybersecurity is very roughly split into network-centric models. So companies like Zscaler, Cloudflare, that's ticker ZS and NET, and then endpoint protection, which is basically device protection, and those are companies that include CrowdStrike, SentinelOne, names like that. So CrowdStrike comes at security from the device perspective. That's probably a position that's going to get eroded over time by the network players, but not that quickly. And so I suspect the stock's got some good growth in it yet. But if you're going to roll forward 10, 15, 20 years, probably a lot of this will be done in the network. So the quarter came in, they beat their estimates. And if you just look at the fundamentals here, this is a company with now over $2 billion of trailing revenue, and it's growing that revenue base 48%. So it's a pretty remarkable growth rate for a company of this size. And although growth is slowing for sure, so you can see all these yellow boxes are slowing growth. The fact is that's still high growth for a company this big. Gross margin is trending down a bit. That's a little bit of a concern. So that tells you, gross margin is gross profit divided by revenue. Gross profit is revenue minus cost of goods sold, and cost of goods sold is all the variable costs. So it's the cost that the business incurs to secure any revenue at all. No revenue, no cost of goods sold. So usually it's things like sales commissions, third-party payaway commissions or platform costs, those sorts of things. And CrowdStrike's gross margin is a bit low for a software company, to be honest. And so you want to see that hold over 70%. I mean, 72 where it is now is that's a little bit low. And if your gross margin falls, as you're paying more for the revenue, if you think of it like that, it becomes harder and harder to generate strong cash flow margins because you've already given away a lot of money before you even get to your operating costs. Operating income negative, that's depressed by an awful lot of stock-based comp. So in quarter, operating income was 62 million negative, but there's 152 million of stock-based comp this quarter. So operating income before stock-based comp, about 90 million positive. The way we calculate this to back it all out to get back to a sort of a cash profit measure is we add back depreciation and amortization, which is non-cash, add back stock-based comp, non-cash, to get us to an EBITDA measure, and we have therefore an accounting EBITDA margin of 18% here. CrowdStrike, for some reason, I must admit, I don't quite understand it. It's really heavy on capex, really heavy on capex. I mean, it's a software company and it's spending, 10% of its revenue on capex this quarter. That's a lot, and so that hits its cash flow margins. Now, on the plus side, it manages working capital incredibly well. If you look on this table here, every single quarter but two, going back to April 2018, it had net positive change in working capital. In other words, it got paid a lot faster than it paid anybody out. And that's a function of having plenty of operating leverage, plenty of leverage versus its customers versus its suppliers. So it charges a lot up front for its contracts and it pays out slowly. So that capex is high, kind of gets hidden in the cash flow margin because they're so good at managing those collections and the upfront billings. So it still has a high cash flow margin at 21% on a trailing 12-month basis, but it is moving down a lot. So if you look back as recently as October 21, the company was turning in 29% cash flow margins. That's down to 21 now, so that's quite a drop. And especially given that revenue growth is slowing. Normally in enterprise software, what you see is if revenue growth slows, cash flow margins go up. And if revenue growth accelerates, cash flow margins go down. That's the normal relationship. So it's a bit of a concern with this one that we've got falling growth and falling margins. Not an issue for the stock today or the company today. The market hasn't noticed and doesn't care, but that's just a nag for the future, that one. So if you follow CrowdStrike or you own it or you're thinking about owning it, just have that on your horizon, which is at some point the market will notice this stuff. Slower than you will because you go through all this cash flow analysis with us, but at some point the market will notice. Balance sheet, rock solid, $2 billion of net cash, and deferred revenue, which is prepaid orders. So this is orders the company has taken. The customer has accepted the order, they've signed a purchase order, and in addition, they've accepted an invoice, and they may have paid the invoice. So deferred revenue is a liability on the balance sheet, and it's matched by two assets: accounts receivable, that's if the customer has accepted the invoice but has yet to pay it, or cash if its customer has accepted the invoice and paid it. So deferred revenue tells you how much stored up cash and receivables there is to deliver service against. It's a good thing. You want a lot of deferred revenue. You want it to be growing quickly because it means you're selling a lot of stuff up front. A lot of stuff sold up front means you're less likely to have revenue surprises. Less revenue surprises means less stock volatility. So deferred revenue sits at over 100% now of TTM revenue. That's good. So that means they've got agreed invoices or paid invoices worth the same as all of the last 12 months revenue. That's really good. And it's growing at 54% a year. And that's good. It's growing at around the same rate as trailing 12-month revenue is. So nothing in the deferred revenue line tells you that you're going to get any major slowdown in revenue growth. We may get that, of course, it's not certain, but there's no red flags in the rate of upfront sales. Stock responded positively, so it moved up. Let's just check where it is now. 1 second. Okay, so it fell back a bit today. So it moved up positively in after hours yesterday and early this morning. It's fallen back a bit today, but still up on the prior to the announcement. And the market's asking you to pay just under 13 times trailing 12-month revenue for 54% revenue growth business at a $2 billion scale. So not cheap, but not silly, frankly. Let's look at the chart for CrowdStrike, and then we'll pause for questions before we move on to MongoDB. Okay, so here's Crowd. This is a larger degree chart, it's a weekly chart. And one of the things that we're finding really useful here, as we measure the sell-off in 22 versus the run-up of these names in 20 and 21, is an awful lot of these names are finding support at 78.6 retrace of the whole move up from the COVID lows. And CrowdStrike's no exception. So it hit the COVID crisis low here, week of March the 15th, 2020. So again, this is a weekly chart. Puts in a huge move up, moves from about $30 a share up to about 300. So basically 10x your money in the course of only 18, 20 months or so, pretty remarkable. And then sold off just as quickly. So dropped from 300 a share down to around 93 a share in the course of, let's have a look, just over a year. Now this 78.6 retracement has proven to be a key support level for many of these high beta stocks, and no different for CrowdStrike either. So you can see that once it hit this, it tested it once in January the 1st week, and then tested it the following week, the week of January the 8th, and just moved up without a break from that. Now that's a pretty rapid climb that CrowdStrike's put in. So it's moved from a low of 93, let's call it, in early January to a peak of 135, and you know, look at the importance of the fib levels here. So I'm just going to zoom in right here. So it finds support, double test that support at this 78.6 retrace, and it finds resistance at just underneath that 61.8 retrace. Now that's not an accident. You know, this comes down to programmatic trading, and so learning to speak fib, learning to speak Elliott waves can help you work out where support and resistance may take place. So what we may see now is a little, I mean, it might power up, of course, but we may see a little sell-off in CrowdStrike. What we may see, if we just measure this, is the stock might drop off. Just 1 second. We may see it drop to 180, maybe even down to 101 again. And if we do, if it holds support at that 108 or that 101, that doesn't mean that the bullish move up is cancelled. It's just a normal ebb and flow of stocks as they climb at a larger degree leg up. So we'll see. I mean, it could just power away, but that's a big move in a short time. And you know, normally when you see that, stocks are due a correction. So we'll see if CrowdStrike corrects in the near term. And if it does, again, it's not something that, at least speaking personally, I should be too worried about my long-term CrowdStrike holding. But it may be an opportunity if you want to get into this and you get to do so. We probably get a retrace now. Let's give you another shot. Okay, so that's CrowdStrike. Before we go on to MongoDB, if anyone has any questions, points, anything at all on market, the Fed conversation, Nasdaq, CrowdStrike, or frankly anything else in tech, then now's a great time to speak up. So everybody's unmuted at your side. Ron, you've got your hand up. I'm going to unmute you. Hang on. Okay, go for it.
Alex, when you were going over the balance sheet, you expressed some caution about some things you were seeing, and you said at some point the market will realize this and there will be a drop. And I kind of missed what you were referring to.
Okay, let's go this again. It's the cash flow margins. It's not the balance sheet. So the balance sheet is rock solid. Right? So there's $2 billion of net cash on the balance sheet. Actually $2.7 billion of cash and short-term investments and $740 of debt. So $2 billion in net cash, balance sheet, safe as houses. Now this is the issue. It's this combination of the declining rate of revenue growth. Okay, so CrowdStrike's revenue growth peaked in January 2020, but again in October 2020. So trailing 12-month growth, 89% in that April 2020 quarter, 93% growth in January 2020. Okay, and it's dropped every single quarter since, sequentially, till this quarter where it's now at 54%. So that's normal. You know, as companies grow, you can't grow a $2 billion revenue business at 100% a year. Or hardly ever happens. It's normal to see these growth rates come off. It's just the law of large numbers. It's just how much absolute revenue can you add each quarter. You know, to keep something growing at 100% a year as it gets bigger, that's just a vast amount of revenue each quarter to find. So there's nothing particularly to worry about in that declining rate of revenue growth. As long as it holds up, you know, above, I don't know, 35, 40%, then that's pretty good. The issue is that normally in enterprise software, as growth falls, it means that your wide open addressable market is getting a bit smaller than you thought. And what that usually means is you start to back off on spending, right? So you don't spend as much on sales costs, you don't spend as much on marketing, you back off on R&D a bit, because the whizzy great new thing that you invented and you're selling, you know, like this, like it's going out of fashion, starting to slow. It's slowing because you're reaching a maturing audience, right? Lots of the people who are desperate to buy the product have bought it. Your rate of innovation slows, always the case in software companies. CrowdStrike has failed to use its cash balances or its stock to acquire much. They've made some acquisitions, but nothing really transformative. And so it's normal to see revenue growth slowing. But what's concerning is that they're not correcting for that with cost control. So these cash flow margins are coming down. So why CrowdStrike was an incredible business in early 21, and it wasn't just, you know, Cathy Wood fed hype, is you don't very often see a business growing revenue at 70% a year with nearly 30% cash flow margins. They just don't exist. And so now it's growing less. You would expect margins to at least have held up, but they haven't, they've shrunk. Now, the market doesn't look at cash flow margins, it looks at EPS and a whole lot of other imaginary stuff. And that's why this stuff always comes as a surprise. So you won't see any analyst notes saying unlevered pre-tax cash flow margins have slowed. And that's a worry because revenue growth is always also slowing. That's buy-side analysis, not sell-side analysis. And what I'm saying is that this will surface in the market. There will be a narrative around this, but not yet. So there's two ways to act on that. You either go, well, I know this problem's coming, stay away from the stock. And you can do that, but very often trends in stocks play out for a lot longer than it takes for reality to surface. And that's personally my guess here. So I own CrowdStrike, happy to own it. I bought it, had some success with it in 2020 and 21, sold out at a good level, bought back recently at a good level. It's done well for me. And staring at this spreadsheet, knowing that there's problems ahead, I'm still happy to own it for a while. I also think there's problems ahead with their positioning in endpoint devices. I believe that in-network is a much better answer, a much more scalable answer, a cheaper answer to security going forward. And so I think that companies like Zscaler and Cloudflare are much better set for the long term. But again, that's not something that's going to affect the stock tomorrow. So for now, you have a company that's high growth, high margin, you know, 21% cash flow margin, still good margin for a company growing at 54%, but you've got the beginnings of trouble storing up there. And what I'm saying is, market hasn't noticed yet, but it will at some point. So just, you know, be ahead of the market on this.
Okay, thank you.
Welcome. Anyone got anything else, folks, on the Nasdaq or frankly on the Fed or on CrowdStrike before we move on? Okay, right, I'm going to mute you again, Ron, if you don't mind. There we go. Okay, so let's do MongoDB. Mongo reported today after the close, so a little while ago. Now, let's check where the stock is because it sold off a fair bit after hours. So let's look at the stock first. Yeah, it's about 7 points down. Okay, so let's look at the numbers. Now, they just delivered an incredibly good quarter. So if you don't know MongoDB, they're a database business. They're a so-called NoSQL database business. And so in comparison to monolithic relational database systems of old, so that's things like IBM DB2 or Microsoft SQL Server or various Oracle applications, NoSQL databases are typically much more lightweight applications. They can run faster queries. You don't need as much database admin or coding skills to interrogate them. And they first found favor in relatively lightweight applications, typically lightweight online apps. Because they're cheaper and faster, NoSQL databases are slowly taking share in the market from what used to be classed as enterprise scale database vendors. And this is happening slowly because enterprise databases are scary things to mess with, and you don't change vendor lightly. But where MDB is enjoying some growth is that as its customers and its type of customer, which is to say more modern businesses running purely in the cloud, not wed to long-lived Oracle maintenance contracts, as its customers grow and as more companies form today won't consciously seek out Oracle to buy, they'll look for lightweight solutions like this one, then their addressable market goes up in size, and their ability to compete with Oracle, Microsoft, IBM, and so forth also increases. So this is a good stock to own for the long term. It's well positioned. Its products have increasing numbers of use cases. It's the seriousness of its deployments are increasing, and also its financials are getting pretty good. So let's just run through this one, and then we'll talk about the current quarter. So this is a relatively small business. It's about half the size of CrowdStrike, just over $1 billion of trailing revenue, $1.3 billion as of this current quarter for the last 12 months. It is just starting to turn cash flow positive. It's not quite there yet. They put in cash flow positive quarter this quarter. That's, I think, their fifth ever, we'll look at it. And if you look at their accounting margins, their EBITDA margins, their first positive EBITDA margin was last quarter, the October quarter. So they're just at that turning point from unprofitable to profitable. However you care to manage the profit, they're just about there. I'm sorry, however you care to measure profit, they're just about that turning point. Now, that's an important place to be because the stock got a big pop last quarter because it turned from having the hated label of unprofitable tech, which right now is deeply unfashionable, and it turned into profitable tech, or might be profitable soon tech. And that sounds silly, but it's a big difference. If you are profitable and cash generative as a company like this, you can be bought by a whole lot more funds than if you are loss making. Many large funds will only buy profitable companies. They won't buy EPS negative or EBITDA negative or cash flow negative businesses because they deem them to be too high risk. So the company turning accounting positive, cash flow positive is a really important thing for the stock. It means there ought to be, all other things being equal, more demand for the stock, and so that can propel the stock upwards by itself because there are more buyers that can own it. So if we look at this quarter, the company absolutely smashed its revenue guide for the quarter. So it beat its own guide by about 7 or 8%. It put in a 36% growth quarter, which again is trending down. So peak growth for this one was around 57% in the April 22 quarter, and that's come off a little bit just now. But again, 36% revenue growth is still good for $1 billion plus business. Trailing 12-month basis, you've got 47% growth. Gross margins 75%, and ticking up a little bit here as well. So if you look back in time on a TTM basis, they were in the low 70s back in 2019 and 2020. Now 71, 73% as of the current quarter. So margins are improving here. EBITDA margins ditto. If you go back to 2019, you had negative 20% trailing 12-month EBITDA margins. We're now at positive 4%, and it's ticking up in quite a managed, measured way. And looking at that sequence, you can see that the company's managing this actively. It's not an accident where their margins come in. They're managing to that. Cash flow, similar, negative 12, actually negative 18% on a trailing 12-month basis back in 2019. Now, negative 2%, and a good chance that turns positive in the next 2 or 3 quarters. There was a couple of chunky negative quarters to get out of the history as the next 2 or 3 quarters roll in, but pretty soon this should be cash flow positive. Balance sheet is fine. It's not a wash with cash. $700 million of net cash after debt. It's okay. That's not imperiled anytime soon, and they're not slipping into further debt. In fact, the net cash levels are going up somewhat. Deferred revenue growth is deferred revenue at MDB that they don't sell that much ahead of time. I wish they did, but they don't. So it's not a desperately relevant metric here. Only about a third. Deferred revenue is only worth about a third of the last 12 months revenue, so it's not really determinative of where the revenue line comes out each quarter, or it's not really a driver of the stock, I don't believe. So we noted down here, but it's not something that I think is really material. What's material here is, does the revenue growth hold up? Do they turn EBITDA positive and stay there? And do they turn cash flow positive and stay there? The stock was down after hours today because the guide they put in was for a drop to 21% revenue growth. You have to reach your own conclusions, but they smashed their growth. They smashed their guidance this quarter. Management teams that tend to be conservative tend to always be conservative, and so there's a good chance that that's a cautious guide that they can beat next quarter. But we'll know what we know, and it's always easy to go, oh well, they're sandbagging. Of course, I know it's going to be better. That's an easy narrative to tell yourself, which might not be true. So the stock did fall off in the after hours. It's at 208 right now. So if we just look at what that means for the valuation, the market's now asking you to pay just under 11 times trailing 12-month revenue for 47% growth. So that's the same sort of ballpark as CrowdStrike really, but CrowdStrike is more cash generative. Growth looks like it's holding up a bit better, and so if you were going to compare them, you'd probably say CrowdStrike's a bit better value really on fundamentals, even though the absolute revenue multiple here is lower. Let's take a look at the MongoDB chart. Now, again, this chart is exactly the CrowdStrike chart. It's quite remarkable. So just to show you, it's not in fact CrowdStrike. Here's CrowdStrike. Okay, so we get a low around the COVID crisis time, March the 15th. We get a 10x return pretty much up to the end of 2021, and then we drop to a 78.6 retrace of that whole wave one up, large degree wave one up. Okay, that's CrowdStrike. Now let's look at MongoDB. Okay, so if you were to measure it from the 2020 lows right here, we go back a bit further here. To the 2020 lows, $96 a share, peaks at nearly 600. So what's that, about 6.5 times your money, and then a hard drop into 2022. Now we've seen this bounce here, and again a fairly rapid, if bumpier, move up for MongoDB, and that it has sold off here again is not a coincidence. So it found support at more or less the 78.6 retrace of its move up from its post IPO lows, more or less, and it's found resistance at the 61.8 level retrace of that move. And so again, you're seeing the stock bounce between these two fib levels, and that's fairly common as stocks move up. We had this stock as hold going into earnings because it basically moved up and out of our accumulation zone into this markup zone. We're expecting late money to come and buy it. It's fallen. It's just still in our hold zone, so at 208, that puts it still in our markup zone here. Falls any further, we're back into accumulation zone. If this is a stock that you're interested in owning for the long term, probably not a bad place to consider buying new positions or adding to those positions. You'll do your own work, of course, but if it's a stock you like, then this looks like a sell-off that's driven by weak guidance. That guidance is probably conservative based on their caution to date, but who can say really? But technically, that's a good long-term buy setup by the looks of things. So that's Mongo. Any questions on that one? I'm just going to unmute everybody. Okay, anything at all? So folks, do feel free to shout into the system here, or use the chat box, or post written questions. Okay, MongoDB, by the way, is not a desperately well-known business. It's well known to boring software people, but it's not a very well-known company, and so you won't see it all over FinTwit. You won't see lots of people referring to it. It's probably a company that has a bright future. I'd encourage you to read a blog called Software Stack Investing, written by a guy called Peter Offringers, former Fortune 500 CFO. We sponsor his blog. It's excellent work. He does some financial analysis, but the product analysis he does there is superb. That's his engineering background. And a catalyst for me was recently his work changed from, I would say, fairly neutral on MongoDB product strength to pretty positive. And so if you get a chance, check it out, softwarestackinvesting.com. I'll post a link to it in the service later on. And try and look at his recent MDB work, and you'll see a reason to get enthusiastic about the company's ability to sell its product into a much wider market opportunity than it used to have. Okay, those are the things I wanted to cover today. So in short, Nasdaq seems to have survived its impact with Powell at Congress these last 2 days. CrowdStrike reported yesterday, solid numbers, stock responded well. MongoDB today, great quarter, really great quarter, weak guidance, stock has sold off on that. And so at least with our measurement zones here, it's still just about clunking into that markup zone, but MongoDB may well fall back into that accumulation zone. Okay, that's all we had. So thanks, folks, for joining us today. The recording will be up in a couple of hours. We'll post it in the service as always. Any questions whatsoever, always reach out in Substack chat or in comments to any of the Substack notes, or you can reach us. There's a contact form on our website. If you head to that to our site, SessionCapitalResearch.com, go contact us, and there's a form there you can use, and that will get right to us, and we'll always get right back to you. Before we go, Ross, you have a question?
Yes, I do, Alex. Thank you. I have a question on both hedges and then also a short. What I've been finding is, for instance, right now I'm following along with, or trying to follow along with both the SQQQ and the TQQQ, and the ratios between those, and I find myself kind of getting lost as to where I am in a particular point in time. And what my question is the only way I can figure out how to get back on track on that is to, go back in chat, through previous messages and all that, which seems like it's a bit cumbersome sometimes. And so what I'm kind of driving at is there some way to kind of have a little snapshot of where your staff accounts are at in using those two as an example at any particular point in time?
Yeah, okay, so for anyone that doesn't know what Ross is talking about, let me explain. So in our this is a webinar for our Substack subscribers, for the Tech Select subscribers. What Ross is referring to is our real-time service, Growth Investor Pro, that you're all obviously welcome to join, and we can get you a discounted subscription to that as your members here. In that service, we post real-time index trading ideas, which are based on the 3 times long and the 3 times short index ETFs. So in the Nasdaq, that's TQQQ is the long and SQQQ is the short. They are high-risk instruments, not to be messed with, can hurt you badly, but if used well, can be really nice instruments. And if used as hedged pairs, they don't need to be too risky. The answer, Ross, is yeah, I'd love to do that. I'm not quite sure how to do it,
Right.
because the decisions have to be made really quickly.
Exactly.
And it's sort of all that I can do, if I'm honest. And I always, those disclosure alerts that say what's been bought and sold, they're always sent before any trade is placed. And the idea is that you as a member can always trade before we do. That's the idea. Okay. And so, given how fast these things move, it's quite hard to come up with an easy system. Sort of a traffic light or a scoreboard system that always keeps track of it. Right. We could add a specific chat channel for it, but I don't mind doing that. maybe that's the way to do it.
You get pushed. Several of them going at one time, like maybe there's, UPRO and SPXU, and now there's an XLU short, for instance. So there's a lot to keep track of, if you're following along with those trades.
Yeah, there is. I mean, it's the longer term ones are easy to follow. They're just all in that stock central resource in that service. But the shorter term ones, yeah, I mean, I appreciate they can be a bit quick fire. I'll have a think about it. It's not easy to do, to be honest. And so
yeah,
I know that from, I'm a member of various other stock services, and I haven't seen anybody do it brilliantly, if I'm honest.
Yeah, I'm kind of thinking I was just going to have to, start a little notebook, and just so I don't have to go and try and search for things. I can just write them down as you're, bringing them forth, and then that will be an easier way for me to keep track of it. So
yeah, let me give it some thought, because it could be clearer. I agree. It's not obvious to me how to do it yet, and I haven't seen it. If I'd seen somebody else doing it brilliantly, I'd probably just say, well, let's borrow that method. But I haven't. So let me have a think about it. If you have any great ideas, let me know. I mean, the obvious one is to have a specific chat channel for that. Not least because many of our subscribers don't do this stuff, and they think it's all spam, and it is for them. And so, that'll be one way to do it, is to have, an ETF channel which people can just, a hedged ETF channel which people can just ignore and turn off if they're not interested. Maybe that's the way to do it.
Yeah, that's a nice idea.
Okay, I'll have a think about that. Could you give it some thought? And if you think that might work, we might give that a try.
Oh, yeah, I like that idea, actually.
Okay, we might do it. Because I am conscious that a lot of people don't do this stuff, and they consider it to be an irritant. And so if we can give them a way to turn it off, that's good.
Yes, I agree. Thank you.
Okay, man. Good question. Thank you.
Thanks a lot.
Okay, folks, anyone got anything else before we finish off for the day? Okay, well, look, thanks everybody for being a member of this service. Delighted to see all of our substacks are growing really, really well. Tech Select has grown all the way through 2022. It's pretty remarkable given the topic, and shown strong growth in 23 so far as well. So if you like the service, please do tell friends, colleagues, countrymen, family members, frenemies, whoever you like about it. You can start with Tech Select for free. As you know, we don't publish a lot of free stuff, but there is some. And then we offer premium membership for a couple $100 a year, and then pro membership for $500 a year. And if you start off with premium, you can upgrade to pro at any time. We try to keep it really, really cheap. We think the work's great quality, and so we hope to keep growing the service over the course of this coming year. So thanks everyone for being a member here. Thanks for joining the webinar. Video will be posted in a few hours later on today, and we'll see you all next week. Thanks a lot.